quick screen recording and show you guys a couple things, right? So I created this really cool spreadsheet. I'm going to update this and make it more user-friendly, and then I'm going to push it out to people that I help with trading. But basically what I can do is I want to show you guys, I can input any stock I want, and then I can also look at any expiration date. So right now I'm going to look at this coming Friday, and then because I like short-term stuff, right? I'm going to look at strike prices that are kind of near the money, right? So I'm going to do like 35 delta on a put. I'm going to explain to what that means in a moment. Basically, what I'm doing, this is a spreadsheet that automatically updates on a continuous basis with live price data. So I'm going to share with you guys a super cool trading idea with you know, capitalizing on cryptocurrency. Right now, crypto is really down. I think Bitcoin is like 80K. So long term, I don't know what your belief is, but I like cryptocurrency and I like Bitcoin in general. I do want to say a quick disclosure. I'm not a financial advisor. I'm not giving you investment advice. I'm just trying to help you with some information and stuff that I use myself, and I think is very good content to help you be successful. But ultimately, your decisions, your trading decisions, are your own. So I just want to clarify there. So let's get back to this trading idea. So Bitcoin and cryptocurrency in general is super cool, but the problem trading cryptocurrency, like as it is, like buying Bitcoin, let's say, is kind of similar to buying stock. Okay, like, you know, you buy stock, you buy Bitcoin, it goes up, that's great, but it's a freaking paper gain, and you can't actually spend that. Like, do you want to have spendable cash in your pocket, or do you want to like see a gain on some like software program or on a piece of paper when you get your statement? I think that's a broken system. So I like trading stock options, specifically selling stock options, because it creates income for myself that I can live on, and that's in fact what I do live on from week to week. So it allows me to have the lifestyle that I live, and anybody can do that. So let me give you an idea on a trading idea where you can capitalize on cryptocurrency, but you can actually create yourself income on a week-to-week basis. I'm going to look at Mara just as an example. Mara is like a crypto type stock. There's a couple things on the page here. Cash margin, let me just talk about margin briefly. Margin, using leverage, it's kind of like using the bank's money in order to make trades. It's good in a sense that it helps you make more money when things are going your way. However, it's dangerous in a sense that when things don't go your way, it can really, like, long story short, you know, it can actually blow up an account. So I'm talking here about just having like a cash secured account. What that means is, let's say if I sell a Mara put, what I'm doing is I'm committing to buy the stock if it drops to a certain price. So right now Mara is $14.45. Now these numbers are going to update on a continuous basis because this is how I built this program. So $14.46. If I was to sell a, let's say, $13.50 put, I'm committing to buy 100 shares if it drops to $13.50 between now and the expiration date. Now, if I'm not using margin, that means I have to have $1,350 in my account, right? So that's the strike price times 100. I'm committing to buy the stock if it goes down to $13.50 times 100 shares. I have to have $1,350 in my account, right? For that commitment, right now, the trade price is $42. Now, that might not sound like a lot of money. However, I'm only putting up $1,350. So this is like a great trade for people with smaller sized accounts. Sometimes people say to me, okay, Michelle, you're talking about Tesla, you're talking about MicroStrategy, but how about me? Like, I don't have that much cash, right? Like, what can I do? This is a way that you can invest, and you don't even need that much money, right? So you put up $1,350, you sell a $1,350 put, it has a 35 delta. What I mean by that is there's a 35% statistical likelihood that Mara is going to go from the price where it is now to $13.50, the strike price, between now and the expiration date, which is this Friday. So not very likely, right? So it's 35%. I can go more conservative. Like I can say, okay, I want a 20% likelihood. So now it's going to give me a strike price. Just wait a moment till this updates. It's going to give me a strike price that's a little bit lower, $13. But you see that the price went down. So the closer you are to the current price, if the strike price is closer to where it's trading right now, you're going to make more money, right? And that's logical because, there's more of a likelihood it's going to stay at that price or dip down a little bit to that price between now and expiration date. So it depends on how much risk you want to take, right? But let's use our 35 delta as an example. And the reason why I like that is because right now Mara has gone down so much, right? So it's gone down a lot. And the best time to sell a put is when the price is low because you're you're making more money on that, right? So going back to 35 delta, the stock price is $14.47. I'm gonna sell a $14 put. I'm paid $54. If I annualize that out, meaning that like if I put the trade in today's Monday, and then it expires on Friday, assuming it expires worthless, how much money annualized am I making per year? So in this case, again, this is gonna update on a continuous basis, but I'm making 162% per year annualized. It's fucking dope, right? Anytime you make over 100% in your money, that's amazing. I encourage people, don't be like putting your money with a financial advisor with wherever, ABC. Nobody's going to treat your money better than you will, first of all, number one. Number two, most of those guys are nothing but like glorified salesmen, number two. And number three, they kind of talk about, okay, let me invest in some stocks, S&P 500, 8% rate of return, 10% rate of return. Brother, you could get like a 100% annualized return on up just doing these sorts of trades that I'm talking about here, right? So that's an example of a put. Now let's talk about a call for a moment. So covered calls are super, super conservative. What that means is like I'm buying 100 shares. So like right now, for example, the stock price is $14.43 per share. I'm going to buy 100 shares. That means I have to have $1,443 in my account if I'm not using margin, right? Because it's whatever the price is times 100. Now, if I buy shares at $14.43, I can sell what's called like an at-the-money call. That means that between now and Friday, if the stock price reaches $14.50, which is kind of close to that now, or more, I'm going to sell my shares, which is kind of cool. I paid $14.40. I sell them for $14.50. I make a little bit. But I encourage you to see what you make on the option price. That's the premium that you get paid to make the trade. So in this case, it's $65. Again, it doesn't sound like a lot of money, but you're only putting up $1,400. You're putting up $1,400. You're making a guaranteed $65. I say guaranteed because you make the premium when you sell an option. You take in that premium and you keep that regardless of what happens. So it doesn't matter. It's kind of like car insurance, right? You pay car insurance. And what you're doing is you're shifting the risk over to the car insurance company for what? In case you smash your car, they're going to pay to fix it, right? If you don't smash your car, there's nothing that they have to pay, but they don't give you your money back, right? The premium is lost. So this is the same thing. Once you take in premium, you keep that regardless of what happens. So you're kind of like becoming the insurance company. It's a fucking dope thing. I was talking to somebody recently who was talking about options. Most people, most regular people in the world, in the environment, trade options, but they buy options, and they want to they do that because they want to 10x their money. They think, oh my gosh, I think Mara is going to go up. And they want to, let's say, buy an option for $65 in this case as an example, and then Mara goes up, in a short period of time, and they turn their $65 into $600. Okay, you could do that, just like you could go buy a scratch ticket or a lotto ticket at the mini mart down the street, and you could hit a jackpot, right? Or you could go to the casino and hit a jackpot with $1 or $5 pulling the slot machine, but the likelihood of that happening is super low, right? So I'm not a gambler. I just want to create myself consistent income that I can live off and have an amazing fucking lifestyle. So that's what I teach other people to have. So we're never talking about buying options. We're always talking about selling options. I'm buying 100 shares of Mara. I'm paying $14.41 per share. I have to have $1,441 in my account if I'm not using leverage. Then I sell a $14.50 call that's going to expire this week. Why this week? Because I want short-term stuff. I don't know what's going to happen in the fucking stock market. I want short-term gratification. I want to lock in my gains from week to week, right? I'm paid $65. If I annualize that out, assuming that it expires worthless, I'm making 189, almost 200% of my money, brother. Can you do this with your financial advisor down the street? No, you fucking cannot. Where's the risk? Let's talk about the risk real quick, right? So the risk is, let's say you buy 100 shares of Mara and then the price goes down. Well, that's no more risk than if you didn't trade options and you just bought straight stock. Okay, you're going to have a short-term temporary paper loss until the price comes back up. So what does that mean exactly? That means you still get to keep the 65 bucks this week. If the price goes down, you're going to have a paper loss, but you don't recognize any of that loss unless you sell your shares, which I recommend you don't do, right? And then when the stock comes back up again, you sell another call. And then you take in more premium. So it's kind of like a way to create like consistent cash flow income to sustain an amazing lifestyle. Now, what happens on the flip side? Okay, I just talked about what happens if the price goes down. What happens if the price goes up? Well, basically, if the price goes to $14.50 or higher, you're going to sell your shares. Which, who cares? You paid $14.40, you sell them at $14.50, you make a little bit there. You keep the premium on the option, that $65 we talked about. And then what do you do next week? Maybe you do the whole thing all over again with Mara, or maybe you do it with a different underlying. But here's the thing, like selling covered calls, there's like no risk. I say no risk because it's no more risk than if you just bought the stock. You might have a short-term paper loss if the price goes down. Also, the other part of the risk is, okay, let's say the Mara goes up to 20 bucks a share, right? Okay, you're capped at $14.50 because you're committed already to sell your shares at $14.50, so you gave up some upside. However, you gave up some upside for some guaranteed income. So it depends on what you're looking for. But this is a great idea, and the strategies that I use in order to bring in a consistent income on a week-to-week basis. Anyway, I hope that helps.